How do you achieve financial independence through real estate investing? Well, to do so, you have to understand cash flow. In this video, I'm going to talk about cash flow, what it's about, and why is it important in real estate. I'm Jason Atienza with Uptrend Investor, and this video is all about cash flow and why cash flow is king. Cash flow is the cash that you have on hand at the end of the month after you've collected all the rents and all the other fees that you're charging, and you've subtracted all of the expenses that you have, and you've subtracted the mortgage or the debt service, and what you have at the end, which is hopefully a positive number if you've purchased it right and you've done your math right, then the positive number is your positive cash flow. That's the amount every month that you can use towards investing in another property or living off of that cash flow. And if you generate enough cash flow per month through passive investments, through real estate investments, then that is how you achieve financial independence, through real estate investing. So in this video, I'm going to talk a little bit about how to calculate cash flow and really the importance of determining your return on your investment and why it's so important to invest for cash flow and not for appreciation. Okay, so here's how we calculate cash flow, and we do this for every property we look at. Before we even step foot on the property, we run through all these numbers to make sure that we're buying it right and that we're making the right investment. And this is a great way to compare potential investments with each other to determine which is the way to go. So you start off with the income, and you can get this income amount from either the advertisement, which you're going to have to confirm, or from the seller's agent, who can give you the most up-to-date numbers. The income can be in the form of rent or rents, depending on the amount of units you're purchasing. You can get income from laundry service. You can get it from storage. And sometimes you can even charge parking. These are all just examples of rental income. So you add all that up and you determine what is your income for the month. The next step is to look at the expenses, the potential expenses. You look at things like vacancy, which, depending on the city that the property is in, will determine roughly the percentage of vacancy you would see, whether it's 3%, 5%, compared to the gross income. So you have vacancy. You have to think about the utilities and what you pay for as a landlord as opposed to the tenant paying for. You have to think about the property taxes. Other expenses are property insurance. Big expenses like CapEx, or capital expenditures, like putting in money to update the roof or repainting the property or whatever else is needed in order to value add the property and potentially generate more income through higher rents. So capital expenditures, overall repairs, maintenance. Another thing on here is the property manager. If you're going to get one, that could be upwards of 10%. So you want to add that into your expense column. And in general, if you are able to get all these numbers from various sources, really do your homework and look up what the vacancy rate is, get an idea of what the tenants pay for utilities, look at the county property assessor's website. You can a lot of times use a property tax estimator based on the current price that you're about to pay, what the taxes will be for the year, and divide that by 12. That'll give you a general tax amount per month. You can call insurance companies and get quotes for the insurance. And with experience, you also get a better idea of capital expenditures, or you could even call a contractor if you know one, who can get a look at the property before you purchase it and give you an idea of what the expenditures will be for the new roof, for example, and also the same thing for repairs. So ideally you can get those numbers. If you don't have access to those numbers, you could use a general rule, a general number. Some investors like to use 40%, some are very conservative and use 50%, especially if you're going to have property management. So that's a quick way of determining what your expenses are, taking the income, and 40% of that is going to be used towards expense. That is just a rough estimate. It's better to have the actual numbers and really do your homework on that. So after you've had all of your income, you subtract all of your expenses, and that equals what is called your net operating income. It is your income minus your operating expenses, which these are examples of. From there, you take the net operating income for the month and you subtract what is going to be the debt service. And that is the monthly payment you're going to make for the mortgage and the interest on that mortgage. So the debt service number can be determined either roughly from an online source like an online mortgage calculator, or preferably you know a banker, you've developed a relationship with one who can run through the numbers and give you probably the best estimate you could find is through a banker who has gone through this with you. So when you take the net operating income per month and you subtract out the debt service, that will give you the monthly cash flow. And that number is critical. Again, that is the number that helps us determine whether we're going to go for a property or not, whether it's going to cash flow enough that we generate enough income for the year to make it worth our while when we compare that to the amount that we're putting in, and that tells us what our return on our investment is. So this is the way that we calculate cash flow, and it has helped us to purchase the right properties, helped us to have positive cash flow, and minimize the surprises once we've actually owned the property. We try to be conservative, so our numbers will be as good as possible, if not a little bit more conservative than they need to be in order for us to make sure we're buying it right. So as you can see, the cash flow amount is determined by several factors here. So your debt service, for example, is based on the price, the sale price. So of course, the lower the sale price, the more that's in your favor, because then the debt service will be lower and therefore your cash flow will be higher. So there's a lot that goes into this. This is the general way for us to generate cash flow. So that's why it's so important to look at cash flow as a means to determine which properties you want to go for and which ones you should pass on. You'll see us use these calculations for a lot of deal reviews we'll be doing on this channel. So I recommend you subscribe to this channel if you're interested in this type of content. If you want to see the deal reviews, you don't want to miss out on those, you definitely want to subscribe, hit the notification bell, and that way you'll get these videos on a regular basis. If you like this content, give us a like, and definitely comment below with your thoughts on cash flow and your experiences with these calculations before and after you've made a purchase. So we hope you liked this video, and we'll see you on the next one. Thanks a lot.